Next question. Cool Limited makes thermal clothing for winter sports and outdoor work and is considering Sking Shell Ltd, which manufactures and sells ski clothing. Sking Shell is about one quarter of frozen size and manufactures its entire product line in a small rented factory in on a mountaintop in Manali. It costs 10 lakh a year in overhead to operate in the factory. Cool Limited produces its output in less popular north but more popular northeast locations. Its factory has at least 50% excess capacity. Cool's plan is to acquire Sking Shell and to combine production operation in its northeastern factory, but otherwise to run both the companies separately. Sking Shell beta is 2. Treasury bill currently yield 5%. So this is a risk-free rate of return provided to us. This is beta information given to us. Nifty index is yielding 9%. So this is a return on the market portfolio is given to us. Income tax rate of both the firms 40%. Because Sking Shell will no longer be maintaining its own production facilities, it can be assumed that only a minimum amount of the cash will have to be reinvested to keep the equipment current and for future growth. This amount is estimated 1 lakh rupee post tax per year. Selected financial information for Sking Shell is as follows. Revenue is given, earning after taxes is given, and depreciation is given. A part of the question. Calculate appropriate discounting rate for evaluating Sking Shell acquisition. That is the question. Everybody please go through the question and then we'll start solving it. So friends, over here question is providing simply that Cool Limited is acquiring company and Sking Shell is target company. In the first part of the question says that so you're required to compute the required rate of return. So calculation of the same is very simple. It can be calculated as like risk-free rate of return plus beta into Rm minus Rf. That is the way we are required to compute the first question answer. So write down answer along with me. Answer of the A part of the question. Calculation of appropriate discounting rate for evaluation. In that Rf plus beta into Rm minus Rf. Risk-free rate of return is 5. Beta is 2. Rm is 9. Rf is again 5. 2 into 4. That is 8. So in the first part of the question, the appropriate discounting rate is 13%. Determine the annual cash flow, second question, expected by acquiring company that is Cool Limited from Sking Shell if acquisition is made. Do not forget to include synergy. I request you to give answer for the B part of the question in the chat box. So friends, we understand over here the cash flow is very simple. Earning after taxes is 13 lakh. Add back non-cash item depreciation 6 lakhs. Then language of the question is very clearly providing to us over here that Sking Shell is about 1/4 of frozen size and manufactures its entire product line in small rented factory on mountaintop in Manali. It costs 10 lakh rupees for overhead to operate the factory. So presently we are incurring an expense of 10 lakhs over there. The question is providing further information. Because Sking Shell will no longer be maintaining its own production facilities, it can be assumed that only a minimum amount of the cash will have to be reinvested. In a way, that's the question is providing the information like this. Cool Limited produces its output in less popular north but more popular northeast location. This is important. The factory has at least 50% excess capacity. Now, in this excess capacity, say now this work will be done. So, what will happen? This 10 lakh rupees of the cost will be saved. So, here we will be having, say, working like this. Listen me carefully. We will be having earning after taxes of an amount of 13 lakhs. Then we will add back depreciation. Why? Because it is a non-cash item. We are interested to know the cash flow. So depreciation is required to be added back. Add savings of overhead. What is the amount of the savings? 10 lakhs into 1 minus income tax rate. So 10 lakhs into zero point 0.6. There is a savings of 6 lakhs. And the question is providing the information that say just to make sure that say all those equipments are say in proper condition, only a minimum amount of the cash will have to be reinvested to keep its equipment in current and future growth. This amount is 1 lakh rupee post tax per year. So we understand that's a less maintenance expenses. It is an amount of 1 lakh. It is post tax, so we don't have to make it post tax. However, this savings is pre tax, so it is required to be made post tax. 13 plus 6 plus 6 minus 1. So the annual cash flow will be 24 lakhs. This is the annual cash flow that we will have, say, from acquisition of the target company. I request all of you to write down answer. Annual cash flow. I want you to answer the C part of the question in the chat box. Calculate value of acquisition means the price that you are ready to pay. Calculate the value of acquisition to the acquiring company Cool Limited, assuming the benefit last for 5 years, last for infinite period, but not grow. Please write answer for both of them in the chat box. C part of the question, in that we understand value of acquisition. Dear students, the term value of the acquisition means the maximum consideration that you are ready to pay for acquisition. That is what we are required to calculate. So the time period and value. In column number 1, time period I am writing 5 years, and in value I am writing something like this. 24 lakhs into PVIFA at the rate of, just now we have calculated the discounting rate, it is 13% for 5 years. This is the way we are required to do answer. So 1 divided by 1.13 1, 2, 3, 4, 5. 5 years factor summation is 3.5172. 3.5172 into 24 lakhs. That comes to 84 lakh 41,280. This is the way we are required to find the value of acquisition if at all the benefit is likely to last for 5 years. In the second question, it is perpetuity. So what will happen? P0 is equal to A1 divided by I. What is A1? A1 is 24 lakhs and discounting rate is 13%. 24 lakhs upon 0.13. It comes to 1 crore 84 lakhs 61,538. This is the way the present value of the future cash flow can be calculated, and that is the value of the acquisition. Right on answer? So this is the value of the acquisition is calculated considering the time period for which you are going to get advantage. The part of the question is extremely simple. Sking Shell has 2,50,000 shares. That is the target company. Stock outstanding. Calculate maximum price Cool Limited should be willing to pay per share to acquire the firm under the two assumptions in part C. So what is the price that you are ready to pay on per share basis? That is a question. So answer for the D question. Calculation of maximum price that Cool Limited is ready to pay for target company Sking Shell. Again, the time period is 5 years and the time period is perpetuity. Price per share. Whatever the answer that we have calculated, 1 crore 84 lakhs 61,538 divided by the number of shares, 2,50,000. So maximum price that you are ready to pay is 73.85, and for 5 years time period it is 8441 280. 8441 280 divided by the number of shares will be 2,50,000. So it is 33.77. This is the price that you are ready to pay on per share basis. Please write down answer. So summary of the entire answer. In the A part of the question, we have to compute the discounting rate by using the CAPM. In my opinion, second part of the question is important, in which you have to properly recognize that they have provided the information about this savings of 6 lakhs and expense of 1 lakh. Once you make this calculation, the answer of the C and D are very simple. The present value of the future cash inflow is the value of the acquisition for a time period of 5 years and for a time period of perpetuity. That is supposed to be divided with the number of shares, and with that say we compute the price per share. Please write down answer.